The stock market is currently up 0.2%. Today is Monday, February 9th. Welcome, everyone. It's great to see you. Hope you had a great weekend and enjoyed the Super Bowl, maybe. But anyhow, jumping right into today, I am recapping off of last week. I had rotated into throughout some software and into Microsoft. Microsoft is doing well today. It's up over 3%. However, I am considering trimming that because I'm growing more cautious on the large cap technology trade. By the way, there was a reputable research firm called Melius, and they revised downward their free cash flow expectations for Microsoft this year. Again, you and I had talked about the large technology players and how much they're spending and how that is really dropping down their free cash flow. As a matter of fact, for 2026, Meta and Google both, or Alphabet, I'll just call them Google, they're expected to have zero cash flow, zero, none. And actually, Amazon is going to have negative cash flow. And so again, Microsoft, their free cash flow was revised downward. And Google this morning as well announced that they are going to have a debt offering to raise some capital. So they're going to issue some bonds, and they're going to raise $15 billion. So these largest companies, which throughout the years, we've talked about it before, have just been huge juggernauts of generating cash, are now either barely breaking even or negative on the cash flow, raising debt. And we've talked throughout last year, the second half of last year into this year, January, how we in 2025, that was our safety base, was running back to those largest technology names. And that can't keep going on forever. And although, I am still in and believe in these companies and what they do, that contraction of their balance sheet is significant. And I just wonder how many times we can keep going back to that safety trade. So I'm getting, with every time we have to go running back, I get more and more cautious. So there's that. I'm just wondering if, the market is going to reset what they're willing to pay for these companies based off of their contracting balance sheets. It's just, we've talked about it over time. Earnings they win out over time. And those earnings are going to suffer because of that cash flow. Not that it's not worthy, not that artificial intelligence isn't all that and going to pan out in the future. And it's just the fact of where you put your money and how much that costs you and what your opportunity costs are. Opportunity costs being where else could you put that money? And so I'm just wondering if that premium valuation that has always been assigned to these amazing companies, whether or not that is going to be start to get pulled back. So that's really on my mind. So another concern that I have is market psychology. This weekend, and here's an anecdote. This weekend for the Super Bowl, there were a few people that bet. One person bet over $250,000, over $254,000 was the number, on the coin flip to start the game, literally on a coin flip. And the thing about that was that the payoff on it was 3%. So if you invested $1,000, you would have, or let's say $100, you would have received $3 back if you won, the flip of a coin. This person lost $250,000. If they had won, they would have profited a little over $7,000. It is what it is, but my evaluation of it is there is so much more gambling that is being permeated and perpetuated into the market. Not that there's anything wrong with gambling. I love going to the tables at Vegas and playing blackjack, and but when it gets to this point, and we see all of these prediction markets such as Kalshi and all of the betting that can go on, the mindset, that gambling mindset, which we know can be very addictive, um, how that's going to affect the market. So uh, this is, for me, this is about real companies doing real things with real moats to competition. And so when I see all this gambling, and there are other examples, all that, and high speculation trades, that I then like to, for myself, go back to double down on that mindset that I don't chase, stocks, and I want to refocus on basics, on fundamentals. What do these companies do? What do they do better than anyone else? And why are they worth investing my hard-earned money? So just a note, an anecdotal note of me refocusing on that, given all of the, investor gambling mindset that's out there. So just something to share. But I do have some good news as well. So the rotation, going back to what we talked about with those largest companies, the rotation into the value stocks is really looks like it's starting to take hold. Now, let's talk about what value stocks are briefly. Just think of them as a bargain, okay? You're not walking into the store paying full price. You're walking to the back of the store, looking on the rack, and finding that item you've always wanted and have been waiting for, and you find it at a great value, but you know that it's quality because you've done your homework. So a value stock, you can think of it like a bargain, and they have lower price to earnings multiples, so you're not paying as much on the price for each dollar of earnings. So they're lower price to earnings multiples. They're generally definitely less speculative, and less high growth. In other words, looking off into the future and thinking, is this software company going to grow at 40% or 50%, and really paying up for that expectation. Rather than that, the value stocks are more, this is the tried and true. These are mature companies that have steady performance. And think of banks, think of energy and utilities. And so over the last 3 years, this rotation from this technology and large technology, centric market, about half a dozen times over the last 3 years, the market has tried to really rotate back into that value trade. And it's failed before. And before, it's been mostly based off of expectations of interest rate cuts. And because these companies anyhow do well with lower interest rates, but it was really based off of the Federal Reserve and what they were going to do with interest rates. And they never, over the last 3 years, nothing held there. But this time, it really looks like over the last 6 months that it's taking a new toehold, in the market. And a part of that um, is that the momentum stocks, which the momentum trade, which every day, every week, that momentum basket, there are stocks that get traded in and out of it based purely on their current, price action and performance. And right now, that momentum basket is a full 1/3 of it is our value stocks. And so it's really hitting the here and now. So I want to think about that. I want to think about that because pairing that with what I was talking about at the beginning about the largest cap technology stocks, that we've gone back to that well so many times to draw water. And now, finally, after 6 or so attempts, that value trade is really starting to happen. I just want to put that on my radar. And a part of putting that on my radar is looking at the stock ticker, which represents, there's the S&P 500, which you and I talk about as far as the market, that is the market, but there's also a ticker called, the ticker letters, our symbol is RSP. The RSP is an exchange traded fund, and it represents the equal weighted S&P companies. So the S&P 500 has all of those companies in there, but those huge companies are overweighted. The top 10 of the S&P companies, the top 10 in size, comprise 40% of the overall weight of the S&P, but the S&P 500 equal weight takes all 500 companies and assigns each of them an equal weight in the, in the 100%. There you go. And the reason that I like that comparison now is because it's really going to allow me, and hopefully you, to compare the S&P cap weighted, which is the capitalization weighted, with those huge companies in there, versus the average company, each of them given an equal weight. And when the RSP outperforms like it has in the last month, the S&P has been flat, but the RSP is up almost 2.5%. And so that really shows me from a broad standpoint what the overall market, where it's going, and if that rotation into value is continuing. So I like it as a comparison, but I just want to remind you, I don't like to invest in ETFs because I would rather pick the best of the best in breed from an ETF rather than a general basket and watch some go up and down and get a meh average return. But there you go, comparing that S&P to the equal weight S&P RSP. That's really going to give a great indicator of that rotation and whether it has legs. And so I want to do one other thing, and that is to add to the theme of this year, as you know, has been volatility. Okay, I want to officially add, like we talked about last week, price action. So the two themes that I am here and focused on here and now for this year are volatility and price action. On the price action front, we're 2/3 of the way through this earnings season. This quarter, the earnings season for the last quarter of last year is happening right now. We're about 2/3 of the way through it, and it has exceeded expectations. It is above expectations on revenue. It's above expectations on earnings, but the price action has been really soft, squishy, is the best way I can describe it. Again, the S&P 500 over the last month has not done anything. And really, we go back to October of 2025, and it hasn't done anything at all. So when I see earnings come in that beat revenue expectations, that beat earnings expectations, but the prices don't follow, the price action is weak and squishy, that is an indicator for me that I really am watching that, because the market's not reacting accordingly and not rewarding these companies for their great reports. And so I'm always unaware, because that to me means that the market is discerning, maybe a little bit, uncertain, and that any bad news following on in that, when that's occurring, in that time frame when that's occurring, any bad news can really be exaggerated. So especially this week, for example, we've got a reports on labor and also inflation. Okay, jobs and inflation coming this week. So I'm keeping a special eye out for that. And so just to recap, that is, I'm adding to the themes for this year, I'm adding to volatility, and it is also now price action. Volatility and price action, I think, are so key. And so I just want to say that to close, that I want to remember that when it comes to your money, number one, preserve it. Number two, protect it. And number three, then make some more, you know? preserve it, protect it, and then think about making some more. And we've talked about that. You've earned it. I've earned it. We've worked our tails off to do that. So just be extra cautious before hitting that buy that buy button. And anyhow, there you go. That's it for today, Monday. And I hope you had a great weekend, and I hope you're having a good Monday, and I'll talk to you soon. Thanks again.